Hey everybody, hope you're doing well. Mike DeAndre here. Want to take a moment and discuss with you the recent geopolitical events that are going on, how it's impacting markets, and the action that we're taking in response to it. So, without further ado, the least expected slide you'd probably be looking for here in this situation, but have you ever tried to untangle a giant ball of Christmas lights? Some are blinking, some are flashing, some are in color. It's chaotic, okay? And I feel like that's a bit of the situation that we are in here with interest rates, inflation, and the Ukraine. All tightly wound, all impacting each other, all very important issues and things that we need to be able to address, and all getting a lot of market share in our minds as we are working through this period in time, okay? But no reason to panic, no reason to be frustrated. There's a process for this, okay? We remember that successful investing is rooted in process. It is not rooted in a section of the tax code like 401k or your IRA or anything like that. It's not rooted in one single investment, okay? It's rooted in a process that can broadly absorb all of this information, filter out the noise, and bring us guidance. And it does that by being consistent, by being unemotional, by being repeatable, and by being price driven. Okay, we want to remove as much of the flack, as much of the noise, as many of the distractions that are being shot at us. And it's entertaining. The distractions are entertaining. The video is spectacular. The Twitter feed, oh my goodness, yes. All of that is true, but it doesn't necessarily help us be better investors, okay? So what we want to be able to do is take a look at each three of these components. This will not be a comprehensive review of each component, okay? We just do not have the time, and this isn't the place for that. But just a high-level general understanding of these three components and then how the process is working through it, okay? So starting with Ukraine, geopolitical risk. This chart, this table provided by LPL, goes back from 1941 to August of 2021 and looks at critical geopolitical issues that we faced and how the market responded. On average, the typical drawdown was just under 5%. It took about 20 days to get to that bottom, and to recover that 5% took on average 43 days. Now there's a wide range, a lot of dispersion between, in particular like the recovery days and on the number of days to a bottom and on the drawdowns. But this is the historical, these are the historical averages that we have to go by just to bring us some context. So generally speaking, on average, they don't last that long, they don't cut that deep, and there is a recovery on the other side of these, events. If we look at a slide that's been circling a lot lately, we see some research done here by Fundstrat where if the market is pulling back, or while the market is pulling back, I should say, during the saber rattling phase, sort of the, yeah, we don't like you either, we're gonna fight, okay, we're gonna fight. And then once the fight starts, the market sort of says, okay, and it buys that bottom, okay, or buys that dip, or however you want to look at it. These little blue hooks are the buying the invasion. Now, doesn't necessarily mean that that rally lasts forever, but it'd be interesting to see where we are in our own little micro, situation here. So from February 24th to March 4th, which is the end of this video is being recorded on Sunday, the 6th. So you can see this is crude oil, energy, utilities, the VIX, continuous, which the VIX being up is not particularly exciting, continuous commodity index, so general commodities, industrials, all the US sectors and commodities have been positive. And then at the bottom you can see the 10-year note, which is down 12%, which was a lift to the bond market. Bonds have been getting hit pretty hard by the rising interest rate environment that we've been in, sort of pricing in these Fed increases. And so generally everything except the VIX being up 5 is positive for stocks. Now, does this mean the bottom is in? I doubt it. Does this mean we have it doesn't mean anything. We have to stay open to potential situations, but it is the information we have from 224 to 34 that this by the invasion seems to have at least slowed the decay that we've seen in markets year to date. Remember, we're already sitting down about 10% in the S&P on its own before we got to this. So Maybe we have that average another 5% to go to account for the Russian-Ukraine crisis. We don't know. So inflation, let's take a look. So I don't have to tell you inflation is up. This is United States inflation rate year over year, looking back to 1915. It's a rather long period of time, and you can see some pretty substantial spikes in inflation, and here we're working on our own right now. You know what a needy culture we are. We have to be first at everything, and so we're trying, this generation's trying to prop up inflation. No, I'm just kidding. 7.5% right now, including energy and food, because I like to eat and I have to get places, and both of those things require food and energy, and I'm going to use those things, and they should be included in my calculation. This takes us back 40 years before we hit that number again. Okay, so this is a rather substantial rise in inflation. Now, when we look at this, some have been saying that this inflation is a result of the Ukraine crisis. This is January 31st of 2020. This is January 31st of 2022, and I see this huge line moving up and to the right. I don't think that's the fault of the Ukraine crisis. That's just me. Interest rates, Federal Reserve, what are they going to do? How are they going to do it? So for some perspective, going back to the 1980s, we see that rates have been lower for longer for a long period of time, okay? They've been cut. There's been incremental raises along the way, but the general trend has been down and to the right with interest rates, Fed fund rate in particular. So you can see that we are sitting here just about zero. Actually, on the Fed chart, it's like 0.08, but effectively zero, and markets priced in a quarter-point hike. A couple weeks ago, it was hoping for a half-a-point hike. I don't think that's on the table anymore. Even in a surprise situation, you never know. But it looks like a quarter point's to be expected. And then are we going to get? There are some people expecting 7 hikes consecutively. That's probably not going to happen. Maybe 4, maybe 5. Who knows? I don't gamble on that type of stuff, but it is important to take into account and then say, well, what impact will this have on equities? Looking at the last 7 raises in the Fed funds rate, the white line with the gray shading coming down is the Fed funds rate. And every time they've raised, we've laid a box over it. And the green boxes are when equities rose while rates were being increased, okay? So 6 out of 6 out of the last 7 increases in rates. I don't have cause and effect here. I don't want to say cause the market to go up, but stocks rose during that time frame. So this is not an automatic, destructive order for U.S. stocks simply because rates are going up. Okay, it's usually a reflection the rates are going up because the economy is doing well, earnings are doing well, employment's doing well. Hopefully all that continues in light of the geopolitical events that we're in right now, but that's just, again, context and perspective. So let's bring it back to process and data. How do we respond to all the things that are going on? And by the way, just because these 3 things are going on right now doesn't mean, gosh, for the last 45 years nothing's happened. That's not the case. So this is an ongoing process. This is an ongoing evaluation of the data. And so let's take a gander here. So the data, not that data, that's terrible data. Look at this data, okay? Something that's clear, something that's going to pull out actionable information. So in December 2021, core equity was at 98% and cash was at 7. Okay, today core equity is still at 90, cash is at 25. Cash has moved up a little bit. Really not to be, shouldn't be overly surprised by that, but we do want to have a little bit of a perspective here. So the market, this orange line represents the 25 percentile rank, and you can see that there are periods where it rejects, goes a little bit higher, goes a little sideways, then rejects, and then there are times where it takes off and we get a spike in volatility and we get a spike in cash ranking, okay? We are still sitting sort of at that first inflection point, and we've taken some action that we'll talk about later, but 25% is not, call all the cows in, put all the ships in the harbor, it's Armageddon. That's not what 25% means, but it does mean you've got to pay more attention. If you've got positions that are really lagging, positions that are substantially weak, maybe you call those positions out. If you've got some really strong positions still, you can let them continue to run. It's not a an order to bring everybody back in and just run 100% to cash. We're only at 25%. Don't want to ignore it, but also don't want to overreact either. And this is one of the reasons we don't want to overreact. I mean, this is going back to 2017. We see I got to get a better name for this correction because it's like October to Christmas, and I call it the Christmas Day Massacre now and then, but it's just not appropriate. There's probably the mob has all the massacre names associated with. Anyway, so that pullback was about 20%, COVID 33%, and we're sitting here around 10%. Again, Monday morning hasn't come yet, so who knows where the market will be on Monday. But as of this recording, we're sitting just around 10% in the pullback, and that's in that normal to be expected range of 5 to 10%. And again, looking at the geopolitical stress in that chart before, do we have another 5 to go? On average, 4.6% pullback to go simply because of the geopolitical phase that we're in. Maybe, I don't know, but we're just going to watch it. We're going to see where we are. Reflecting that 25% money market percentile rank, we can see the VIX is elevated. Those tend to correlate and correspond to each other now and then. But we're not completely blown out here on the VIX. We're sitting in the low 30s, and you know, are we going to hit 40, 45? I don't know. But we're in that sort of Midlands range of heightened risk. Given where we've been, something a little surprised that we're not higher in the VIX. But that's where we are. Now, for the VIX to go down, it has to stop going up, right? So these green lines, this is a shorter term view. This is the end of 21. This is the end of 22. These green arrows just represent higher lows in the VIX. So the VIX pulls up, takes a little breather, pulls up, takes a little breather. But every time it does, that little breather is a little bit higher, okay? And that's a strong trend in volatility. We need that to reverse to have more confidence in broad equity exposure, ownership, in our portfolios, and it has not as of yet. So here's a quiz. This is sector performance. These are all US sectors year to date. One is different than the rest. What is that sector? If you guess energy, you are correct. So energy on the fourth was up just about 35% year to date, and this is broad energy. And it almost is acting, if you have a high concentration in energy in your portfolio, it's more of a hedge against anything else, because it's the loner right now. Even with the threat of interest rates rising, financials haven't been particularly powerful. They've held up okay, down around 5%, but they haven't had the run that we got last year. Maybe that's simply because we got the run last year. Don't know, but this line represents the beginning of military operations in Ukraine when the bullets started flying. So you can see sort of things peaked a little bit or are moving a little bit higher from that spot like we talked about before. But energy has been the show. And it's very difficult to own a portfolio that's 100% energy, especially if what you're predominantly invested in is the S&P 500. S&P 500 only has 2.61% representation in energy. So for you to get energy exposure, you're going to have to go off sort of the index diet and get into a more adaptive investment process. And when we look at the broad rankings today, commodities are sitting in first position. S&P index funds sitting in second position. You could just think of sort of US domestic stocks. All global and international diversified, money market, fixed income, and global currency, all below the 3% line, which you generally would want to own something that has a score of 3% or higher. So the game in town right now is commodities. And does that mean that commodities should always be a long-term overweight in your portfolio? Well, this table represents all the indexes plus commodities, okay, the commodity index, or the energy index, excuse me. And so what you can see is there are times when it is doing spectacularly well, and then you can see times when it's really not doing so great. So as a permanent long-term hold in your portfolio that's an overweight may not always be appropriate, but there are times when it's, I want to say the only game in the only game in town, but when it is something that should get more sponsorship in your holdings and should be a higher percentage of your allocation. Again, over the cumulative period from 2007 to 2022, it's in last position from a cumulative return ranking, but it does have periods of time where it warrants ownership in our portfolios, and we need to have an adaptive process that can put us in that situation, which we do. All right, last two charts, growth and value. Interest rates, again, lower for longer. We looked at that Fed chart where we saw boom, 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 rates are going down, okay? And we don't have a long-term 10-year yield chart, but if we did, you'd see the exact same pattern, all right? That is typically good for growth, okay? And you can see that this chart, this is growth versus value. Actually, this is a bunch of letters that means growth index, and this is a bunch of letters that means value index, and this is a 1 week chart, okay? So each notch in this line is 1 week long. So we're going back to 2013, and this sort of long rotation up in growth was supported by low interest rate environment. As we've gotten into a choppy area up here, this channel here that we're, or this box rather, that we're creating, value is starting to fight for ownership. Value is starting to try to say, hey, I want to assert myself, I want some sponsorship, I want to come out and play, but it hasn't broken out yet. Okay, we've had some interesting channels that could be traded or not. It's been rather quick, but value should be, we should be hopefully getting an answer here on, is this going to resolve itself and growth will continue on, or is this going to break down? And when I say break down, it doesn't mean that it's bad for value, because we can own value stocks, but is this going to break down on the chart, showing that value is in firm control and we get out of this sort of sideways backs? We haven't quite got there yet. We're still, you know, are we at a tipping point? Are we a channel? Do we need to trade this back to growth? A little too early to tell. Again, it's a weekly chart, but it's important that we that we stay very focused on this growth value relationship as we're moving forward. Also want to take a look at gold. This chart goes back to 2007. Gold has made a run up into 11 in that sort of commodity phase of ownership, where, remember, if we were looking at the money market percentile, or the core PR percentile rank, we had the green and the red. Well, commodities were a big part of the ownership, and gold was a great thing to own during the lost decade, and you can see why. It had a great run, but it's had this, you know, we're sort of forming this long cup and saucer program. This is, or formation rather. This is 3,262 days in the making. We've got the handle. We've got a little channel working up, but as of the breakout of war, February 25th, it's only up 2.5%. Hasn't really made the most of a fear move that you might expect out of gold. So we own a little right now, because it's, again, an environment where there should be an opportunity, and it is rising and scoring primarily because lots of other things are falling next to it. But haven't seen that absolute breakout in gold that one might expect. So maybe that's positive for stocks. We'll have to see. So Ron wants to know, hey, what's the point? We've talked about all this stuff. Where are we really getting at? And this is really the point. We have increased our exposure to commodities and energy. Energy has been on the board for a little while, but in mid-February, it really just began to reveal itself that this is going to be the place to be. For who knows how long, don't know yet, but that's where we are for now. Increasing exposure to commodities and energy. We've increased cash positions in relative models. Some very conservative models didn't need the increase in cash, but some of the more equity-oriented models and sleeves did. And we're scanning for opportunities. This is an opportunity for things to pull back and us to step in and take a little bit of opportunistic leeway here. Regularly scanning for opportunities for the next leg that we can put those cash dollars to work. Don't want to just sit in cash. But if the market can't beat cash, it's not a bad idea to own it. And then from a client perspective, expect more rotations, expect more trading as we move through this. Generally, if we can identify a trend and it lasts for 7 years and we hold those positions for 7 years, that's great. We might not be in that situation right now. We might not have that luxury moving forward. So expect more rotations as we are moving through this process. So we've made some adjustments to our website. If you'd like to schedule an appointment, you can click that first little button here and it will bring you to the scheduling page. Also, you're always available to give us a call and take advantage of any other little features here that make it easier for us to communicate with you. So thank you very much for your time and attention as we work through this. It is always a pleasure to serve you. And again, if you have any concerns, please feel free to reach out. Thanks.